All right, let's get right into it. We hear so much about investing, right? Hot tips, market predictions, but how do the pros really think about building a strategy for the long haul? Well, we're going to cut through all that noise. For this explainer, we're going straight to the source, using a classic professional textbook to break down the disciplined process for building a truly powerful investment plan.
And you know it all kicks off with this idea from the book's preface. See, this is the key right here. This whole thing isn't just about numbers on a screen or beating some index. The real goal of a solid investment strategy is to help you live a better life. It's about funding your goals. It's a fantastic way to frame what we're about to do.
Okay, so that's the why. But what about the how? If the goal is a better life, what's the actual framework for getting there? How do you go from this kind of vague idea to a concrete, workable plan that you can actually stick to? That's exactly what we're going to map out right now.
Step 1, and this is probably the most overlooked but most critical step of all. It happens before a single dollar gets invested. You have to start with a blueprint. I mean, think about it. You wouldn't build a house by just buying a pile of lumber and starting to nail boards together, would you? No, you need a detailed plan first.
And it's worth taking a second to look at what investment actually means to a professional, because it's pretty specific. It's not just making money. It's about being compensated for 3 distinct things. First, for the time your money is tied up and you can't use it. Second, for inflation, which eats away at your buying power. And third, and this is the big one, for the uncertainty of getting it back. That compensation for uncertainty, well, that's your risk premium. That's the engine that drives your returns.
So that blueprint we talked about, it has a formal name, an investment policy statement. But don't let the name scare you. Just think of it as your personal rulebook. First, you write down your goals. What is this money for? Retirement? A down payment? Be specific. Second, how will you measure success? You need a benchmark. And third, what are your constraints? How long do you have? Do you need to be able to access this money quickly? Are there tax issues? Answering these questions up front is what gives you the discipline to not panic when things get rocky.
Okay, so you've got your blueprint. Now we get to what countless studies have shown is the single most important decision you're going to make as an investor. It's not about picking the next Amazon. It's not about timing the market perfectly. It's something much, much more fundamental.
And there it is, strategic asset allocation. Sounds fancy, but all it really means is deciding how you're going to split your money up between the major investment categories. And believe me, this one choice is the main driver of your results over the long term.
So what does that actually look like? Well, here's a classic example. You might decide to put 60% of your money in stocks, those are your growth engine, and the other 40% in bonds, which provide stability and income. That's it. That's the decision. And that simple 60-40 split has a bigger impact than almost anything else you'll do.
Just how big of an impact? Get this. Study after study shows that your asset allocation decision, that big bar on the left, is responsible for the vast majority of your portfolio's returns. It absolutely dwarfs the other things we tend to obsess over, like picking individual stocks or trying to time the market. I mean, look at the chart. It's not even close. Get the allocation right, and you've pretty much won the war. So, you've decided on your mix. Now you need to actually know what you're working with, right? What are these building blocks you're using? For most of us, it boils down to 2 main things: stocks and bonds. Let's break this down, because it's super simple when you think about it this way. Buying a stock means you're buying a tiny piece of ownership in a company. The potential upside is huge, but it's also riskier. A bond, on the other hand, is just a loan. You're lending money to a company or a government, and they promise to pay you back with interest. Lower return, but also a lot less volatile. In your portfolio, stocks are the gas pedal and bonds are the brakes.
Okay, we've got our plan, we've got our allocation, and we know our building blocks. Now we arrive at a huge philosophical fork in the road for investors. Once you own those stocks and bonds, how do you actually manage them?
And really, this whole debate comes down to one simple question. Do you believe it's possible, through your own skill or by hiring a genius, to consistently pick investments that do better than the overall market average? Your answer to that question will shape your entire approach.
And that leads to 2 main schools of thought. On one side, you've got passive management. The goal here is simple. Just match the market's performance. You do that by buying a broad index fund, like an S&P 500 fund, and just holding on. It's cheap, and it's based on the belief that markets are super efficient. On the other side is active management. The goal here is to beat the market. This camp believes markets are inefficient and that smart analysis can find undervalued stocks. It's a lot more work, and it definitely comes with higher fees.
The thinking behind that passive, just buy the market approach has a name: the efficient capital markets theory. And the idea is pretty intuitive when you think about it.
It says that at any given moment, there are millions of really smart people trying to find an edge, and as soon as any new information comes out, they pounce on it. That means prices adjust almost instantly, baking all known information into the current price. If that's true, finding a real bargain becomes incredibly difficult.
So, let's wrap this all up with the most important takeaway of all. Being a successful, professional-minded investor isn't about having a crystal ball or predicting the future. It's not magic.
It's about having a process, a repeatable, disciplined process. You see how it's a top-down approach? You start at the very top with your blueprint, your personal goals. Then you make that one core decision, your asset allocation. After that, you pick your philosophy, active or passive. And only then, at the very bottom of the pyramid, do you finally pick the actual investments. It's all about strategy over speculation.
And that really leaves us with one last question you should ask yourself. When you look at your own portfolio, what do you see? Do you see a coherent plan that was built with a disciplined process? Or do you see a kind of random pile of stuff you've collected over the years? At the end of the day, having that process is what separates a real strategy from just a gamble.